The decision by Iran to stop selling oil in dollars is just the latest in a series of moves by both buyers and sellers of crude to reduce their dependence on the US currency. Iran, of course, has a particular interest in de-dollarization as a result of past US sanctions and the reimposition of those previously lifted earlier this year. Over the past few years, Iran was allowed to recover some of the funds frozen under US-led sanctions in currencies other than dollars, and has been trying to recover tens of billions of dollars it is owed by India and other buyers. In 2016, Reuters reported that, looking to mitigate this risk in the future, the state-owned National Iranian Oil Company had sought to have its most recent contracts paid in euros, and was also looking at ways to accept the customer's own currencies in future transactions. Iran is not the only oil trading nation to try and move away from the dollar. 3 other countries, also involved in disputes of one form or another with the United States, are also signalling a move away from the greenback. They are Russia, China and Venezuela. A number of options have been proposed, including rubles, yuan, gold and cryptocurrencies such as Bitcoin. And whilst there are economic and fiscal arguments in support of de-dollarization in a number of cases, for example exchange rate fluctuations, the main impetus to move away from the US currency is political rather than economic. The use of the dollar in international oil trades dates from the 1970s. At this time, the United States was heavily in debt as a result of the Vietnam War, and with a weak dollar following Richard Nixon's ending of the link to gold in 1971, the country sought a way to raise the value of its currency and revive its flagging economy. In a further blow, the price of crude oil went up nearly 4.5 times between 1972 and 1974 because of an oil embargo on the US following its support of Israel in 1973's Yom Kippur War. In 1974, Nixon made a deal with Saudi Arabia for a military alliance with the kingdom. In return, it agreed to price its oil exports in US dollars and to recycle the dollar surpluses by investing in US debt securities. The move also forced countries that imported oil to buy US dollars and to finance their purchases, therefore creating a global demand for dollars, which in turn helped to raise the value of the US currency and boosted the US economy. By 1975, just a year later, the whole of OPEC was pricing in dollars and the petrodollar boom was born. This has allowed the United States to finance its subsequent economic growth over the last 40 years on foreign debt. This debt now stands close to $20 trillion. Any move away from dollar pricing for oil therefore threatens the ability of the United States to go on financing its growth through the sale of US Treasury bonds. This vulnerability has been exploited by past governments opposed to the US. In particular, Saddam Hussein announced Iraq would price its oil in euros, and Gaddafi also proposed a new gold-backed currency for African countries to replace the US dollar. Iran's latest move to price its oil exports in euros is clearly designed to limit the impact of US sanctions, such as new measures to restrict Iran's access to dollar-denominated foreign investment. Investment, we must remember, that is sorely needed if Iran is to carry out its plans to increase its production of oil and gas. More money from outside is also needed for various downstream projects, including new refineries, petrochemical plants, and expansions of existing exporting arrangements. We must remember, though, that this is not the first time that Tehran has sought to move away from the dollar. It's previously sought to obtain a line of credit worth $10 billion from the Chinese to fund energy and other projects. This deal allowed the funds to be provided in either euros or yuan, and there has been further talk of Chinese loans up to $25 billion. But even when they're combined with the original $10 billion of credit, the total is well below the estimated $200 billion worth of foreign investment the country will need to develop its oil and gas industries and to bring them up to modern standards. Given the clear opposition in Washington, any future loans will almost certainly have to be in currencies other than the dollar. Additionally, US nationals are banned from doing business with Iran, and US firms themselves are also not allowed to operate in Iran except via foreign subsidiaries. All of this has the effect of keeping Iran outside of the global financial system. Even pricing its oil in euros is not straightforward, involving, as it does, the use of several small EU financial institutions, since several large European banks are reluctant to handle payments to Iran. Payments in yuan and Indian rupees are also reported to have run into difficulties in some cases, and it appears the ability of Iran to finance going forward is extremely strained. Outside of Iran, China's deteriorating relationship with the United States is also helping to push it towards the establishment of some form of yuan trading area. Its latest move is established a crude oil futures contract traded on the Shanghai International Energy Exchange, which is denominated in yuan, with the aim of turning Shanghai pricing into a regional benchmark. The idea is to attract foreign traders, although it has to be said there is a basis risk between the 7 crude deliverables in the contract and priced in yuan, and those are the same crudes traded in the physical market and priced in US dollars. Attempts by the Chinese to persuade Russian oil exporters to accept yuan in payment have not had much success so far, and there appears to be little appetite amongst major exporters such as Saudi Arabia to give up the dollar in favour of the yuan. Actually, talking of Russia, while US sanctions have had little effect on oil production so far, possible future restriction on Russian access to the global currency market and, crucially, the latest US oil technology may slow down or even prevent planned Russian developments in marginal areas. Those most at risk are probably those in the Arctic and deep offshore regions. Russia has also agreed to pay for Iranian oil in euros as part of a supply contract. Interestingly, the terms of this also involve part payment in Russian goods. The Russians have also discussed with Iran and China, amongst others, the idea of establishing an international reserve currency backed by gold. Interestingly, perhaps with the aim of completing the process of pricing oil in dollars that stemmed from President Nixon's severing of the dollar's link in 1971. Other ideas that are being floated to end the dominance of the dollar, including pricing in Bitcoin. Venezuela, another target for US sanctions, has come up with its own cryptocurrency backed by the country's oil reserves. But given the country's dire economic straits, Venezuela's new petro is unlikely to provide any sort of challenge to the US dollar in the short term. There's clearly an appetite amongst a number of oil-producing nations to divest and embrace alternatives to the dollar. Yet, the petrodollar recycling is a win-win for all involved currently. Oil-rich states enjoy a safe place to store their petro profits, and the US gains a key source of financing. With a few exceptions, any country wishing to purchase oil must first obtain US dollars, creating significant demand for the currency in international markets. Thus, the petrodollar also plays a critical role in generating global confidence in the dollar, and in currency markets, confidence is king. The widespread pricing and trading of crude in yuan, or petro-yuan, would shake this global confidence and simultaneously serve a number of strategic purposes for the People's Republic. The Chinese government has long sought to internationalise the yuan to boost its economic power and to reduce its own dependency on the dollar. As the world's largest crude importer and primary source of investment capital for oil-producing nations, China would naturally benefit from using its own currency over that of a geopolitical rival. The Chinese Communist Party understands, however, that a strong currency is a double-edged sword for the world's largest exporter. Indeed, China has been accused by many in the international community, including President Trump, of currency manipulation or the economic policy of devaluing the yuan to gain a trade advantage. Whilst the case for manipulation was clear a decade ago, recent data reveals convincingly that China has slowly but surely allowed the yuan to appreciate in value. As China continues to pursue an assertive foreign policy, the yuan's regional influence is sure to follow. Beijing's ambitious One Belt, One Road initiative, which seeks to create trade networks across the Eurasian continent and the Middle East, will invigorate the yuan's march towards internationalization. So, does China's new benchmark pose a real threat to the dollar oil hegemony? Not yet. The dollar will not cede its dominance in oil markets anytime soon, especially as US crude oil output reaches all-time highs. Even a Saudi decision to also conduct oil trade in yuan would not be enough to upset or unseat the petrodollar. Beijing's penchant for market intervention and strict capital controls make the yuan a less attractive option than the greenback to foreign energy producers. Instead, China is likely to build confidence in yuan gradually through steady economic growth, proactive foreign engagement, and the inevitable liberalisation of its monetary policy. Down the line, that in turn could signal trouble for the petrodollar. After all, the US dollar may seem unassailable now, but as the Chinese proverb says, dripping water pierces a stone.